This is Robert Kraft. I'm your host for the Planet MicroCap Showcase Virtual Investor Conference 2020. And I'm so pleased to have you here to be with us and partake in the very first keynote presentation of the day. I wanted to say a couple quick words about Ian Cassel before we get to his presentation. For those of you who don't know Ian, he is probably the leading speaker and flag bearer for all things integrity, just everything that you would hope for in the leader for the microcap market. He is that, and then some. You know, he is the founder of MicroCapClub.com, probably one of the best resources out there for microcap investors. He hosts one of the best investor conferences out there with a really cool format called the MicroCap Club Leadership Summit that I've been proud to go to for the last couple of years. And actually has an incredible book series called Intelligent Fanatics, really highlighting some of those leading entrepreneurs that were able to take small businesses and make them into huge behemoths that some names you very much know today. Actually, he also has the Intelligent Fanatics Capital Management. He's the CIO and founder of that firm. And I couldn't be more excited that he's here and to share a few words and his insights, especially in light of everything that's going on. I think, you know, we can all find some comfort in some of the words that he's about to say and share with you today. So with that, I'd like to introduce our first keynote speaker of the day, Ian Cassel from MicroCapClub.com. Ian, take it away.
I want to thank Bobby for inviting me to present today. It's an honor to be a part of the event, and I look forward to listening to the other speakers as well as the company presentations over the next couple of days. You know, given the current backdrop of COVID-19, I thought it would be interesting to talk about a topic that is front and center in not only our lives, but also our investing and our businesses, and that topic is survival. So I've entitled this presentation, The Art of Survival. I thought I would start off this presentation with this chart, and it's a chart that shows my journey as an investor. On the y-axis is capital and the x-axis is time, just like a lot of you listening to this. I learned investing by losing my money and making it back, and losing my money and making it back. And I think everyone listening to this has a similar chart that illustrates their investing journey. You know, it's just that the stories we had along the way are a little bit different. And it's really in the peaks and troughs of our journeys that shape our investing strategy. And it's only when you look back over whatever time period you've been investing, whether that's 5 or 20 years, you realize the ultimate prize is survival. You know, so what I thought I'd do is maybe tell you about a story that happened in one of the troughs in my chart. And to start off, you know, the story was, we have to go back in time to May of 2005. I graduated from Villanova University with my MBA. I was 24 years old at the time, and I went right into my MBA program after undergrad. The reason I didn't take a couple of years off in between undergrad and graduate school, like a lot of people do, was I got accepted as a graduate assistant into the Villanova's MBA program. And basically, what a graduate assistant does is you work 10 to 20 hours per week for a professor or two, and for doing so, the university waives your tuition. And on top of that, they pay you a small monthly stipend, basically enough to pay your rent. And, you know, it's a pretty sweet gig. I got an MBA debt-free while I worked on my real passion, which was microcap investing. You know, by the time I went to Villanova, I was becoming obsessed with on-the-ground due diligence and doing company visits. And, you know, unbeknownst to my professors and even my parents, you know, I would make over a dozen company visits even when I was a full-time student. And, you know, the key to pulling all of this off, making these trips, was only missing one day of classes, you know, because pretty much every day I had to report into the professors I was working for as an assistant. And, you know, you didn't want to miss too many days seeing them, or else they might be suspicious. And depending on how far away the company was, it was a bit of a juggling act getting there and back in a single day to the company. You know, Villanova is just outside Philadelphia, and it was difficult making those trips to the West Coast. You know, it's hard to get there and back in a day, but, you know, basically how I would pull it off is I'd take a 6 a.m. flight out of Philadelphia to somewhere like LAX in LA, and I'd meet with the company for 4 to 6 hours, and I'd take the red eye back and land around 7 a.m. in the morning, and I could still make my 9 a.m. class that day. And, you know, it was quite a grind doing all this, but, you know, for me, graduate school was, kind of basically a socially acceptable way to waste time while I could focus on my microcap investing. My goal even back then was to become a full-time private microcap investor, and quite honestly, the sooner the better. So when I graduated in 2005, I was coming off a hot streak with my investing. I was kind of overconfident, just like a lot of probably people are, listening to this call. When you have a couple wins in a row, you kind of feel overconfident, cocky, and you're kind of in a gunslinging mood, and that's how I was. And by then I was making a lot of connections in the microcap world, and a friend introduced me to a consultant that was involved in a new public company that was doing a roll-up of disaster remediation companies in the United States. And if you remember back in 2005, this was the time of Hurricane Katrina when it devastated New Orleans. And Hurricane Katrina was front and center in everyone's minds. Disaster remediation was a pretty big business. The government couldn't afford the bad PR around not responding quick enough to a natural disaster. And what they would do is they would pay these big commercial disaster remediation firms to be the first response. These firms printed money during disasters. And if my memory is correct, which it might not be, but I believe it is, the second largest disaster remediation firm at the time, they did about 120 million in revenue and about 60 million in net income. So like I said, they just printed money during these disasters. So this consultant who I knew introduced me to the public company that was doing a roll-up of these types of disaster remediation firms. The company already acquired one firm, and they had letters of intent out and a few more, and they were raising capital. Like I said, I liked the story. I was in a gunslinging mood, and I wrote a $50,000 check for 100,000 shares at 50 cents per share. And I can tell you, $50,000 was not a small amount of money back then, and still isn't today for that matter. But I was coming off a big win, and I said, let's roll the dice. I wrote the check. Over the next few months, the company acquired a couple more of these disaster remediation companies. And heading into 2006, there was some meteorological reports that came out that were circulating that were saying the 2006 hurricane season was going to be more active than the devastating 2005 hurricane season. I bought that stock at 50 cents per share, but, my stock was restricted. And as these reports kind of began circulating through retail and institutional investor circles, people realized that this company was a great way to play an active hurricane season. And the stock started to move higher. The stock went from 50 cents to $1, then $2, then $4. And by June of 2006, it was $11 per share. My $50,000 investment a year earlier was worth a cool $1.1 million. I remember staring at that stock certificate in my hands. I couldn't wait to cash it in, just like I'm sure everybody else would as well. But the company was dragging its feet on registering those shares. They were still restricted. And then all of a sudden the weeks started to slip by, and then months. And soon it was August 2006, and we still didn't have really a major hurricane that hit the United States. You see, in the disaster remediation business, it kind of cuts both ways. It can be feast or famine. You can make 50 million in one year, but you could also lose 5 million the next year if you don't have enough hurricanes. I looked closer at the business plan and the disclaimers. It said the company needed 3 Category 3 hurricanes to directly hit populated areas for them to earn what they did the previous year. It didn't take long for investors to realize this as well. No hurricanes meant no revenues, no profits, and a falling stock price. And that's what the stock did. It started to slide. And by the end of 2006, it was back to $2. And several months later, it was back to 50 cents, and then burdened with over 250 million of debt to make those acquisitions. They defaulted, and the equity went to zero. I still have that stock certificate in a frame up on my wall. $50,000 to 1.1 million to zero. When I tell this story to friends, they think, oh, I can't believe you lost $1 million. But for me, that wasn't really the lesson here. The lesson was I shouldn't have invested in this situation in the first place. I often think today, what if I did make $1 million that way early in my investing career? How would have that impacted my investment process and journey from that point forward? Quite honestly, I would have probably just kept gunslinging and ultimately went broke. Probably would have ended up doing something else with my life. But instead, because I lost money on that investment, it helped shape my view of risk. And because I lost money on that investment is probably why I'm standing here today as a full-time investor and why I've survived. So I'm humbled by that. And, getting back to the disaster remediation business, I mean, what an awful business, a business where you need a disaster to do well. It's a business that, it's really hard for a company like that to survive, especially as a public company. And survival is a fascinating topic. If I were to ask people, especially several months ago before COVID-19 hit, if I were to ask you back then, what is the number one characteristic of an exceptional business? I'm sure some would say it's the fastest growing companies. Maybe others would say it's the company that earns the most money. Maybe other people would say it's the largest companies in the world. But I would imagine if I would ask this question several months ago before COVID-19 hit, I bet you very few people would say a great business is one that can endure over a long period of time, a company that simply survives. It was Ian Davis, former managing director of McKinsey and Company, that said, in a very real sense, survival is the ultimate performance measure of a business. It is Japanese custom that the oldest son inherits all of the patriarch's wealth, including titles of all businesses. And if a business owner doesn't have a son, it was also Japanese custom up until the 20th century to adopt into the family a person they trusted, oftentimes a son-in-law, to pass on the business. This is why most of the oldest companies in the world today are Japanese companies. It's not uncommon or unusual to see a Japanese business that is still in the family operate for 100, 200, 500, even 1,000 years. Even the video game company Nintendo is 130 years old. Kongo Gumi is a Japanese company, and it's the oldest company still in operation in the world today. The company was founded in 578 AD. The company builds and renovates Buddhist temples. It was actually still family run up until 2006, a family business that was around for 1,400 years. Kongo Gumi makes it look easy, but surviving is incredibly difficult. Fortune magazine has compiled its Fortune 500 list every year since 1955, and the Fortune 500 list ranks the 500 largest corporations by total revenue in the United States. This list includes both public and private companies. And when you look at the Fortune 500 companies from 1955, only 60 companies remain on the list today. In addition, the average lifespan of a Fortune 500 company in 1955 was 60 years. Today, the average lifespan of a Fortune 500 company is 15 to 16 years. The lifespans of companies are shrinking. In 1955, the Fortune 500 list was filled with companies like American Motors, Brown Shoe, Studebaker, Collins Radio, Detroit Steel, and many others. These companies were the largest companies in the world, and now they're gone, wiped out. Why is it so hard for a business to survive? For the answer to this question, we're going to look to Winston Churchill. Winston Churchill is most famous for being the Prime Minister of the United Kingdom and leading the country through World War II. Churchill was a politician, a statesman, an army officer, and a rather prolific writer. In fact, Churchill would write 42 books and earn the 1953 Nobel Prize for Literature. John Rockefeller, the world's richest person ever, actually wanted Churchill to write his biography for him, but Churchill's price tag was too high. Churchill wanted Rockefeller to pay him $250,000 to write that biography. But if we look at the picture on the screen, Winston Churchill is young on the left and rather old on the right. He lived to be 90 years old, and 90 years is a long time. But what is fascinating about Winston Churchill is the time period in which he lived. He was born in 1874. In 1874, the year Churchill was born, there was no electricity, there was no radio, there's no television, no telephones, there were no light bulbs. Homes were still being lit by candlelight and gas lights. 1874 was only 9 years after the Civil War ended. Winston Churchill died in 1965. Just think about how different the world was in 1965 compared to 1874. By 1965, men had orbited the Earth, walked in space, sent a probe to the surface of Venus. An automobile had already driven 600 miles per hour. Nuclear power was being used. The Beatles just won the British Order of Merit, an award that Churchill himself won 20 years earlier for completely different reasons. It's rather remarkable to think about the amount of change that Churchill witnessed throughout his lifetime. Everything changed. This rate of change was something that was constantly on Churchill's mind. Toward the end of his life, Churchill said, I wonder often whether any other generation has seen such astounding revolutions of data values as those through which we have lived. Scarcely anything material or established which I was brought up to believe was permanent and vital has lasted. Everything I was sure or taught to be sure was impossible has happened. Now I want you to think about that rate of change through the lens of a business. How hard it must be to operate a business through that type of changing environment. Think about the companies that have endured over a long period of time. I mean, many of the products or services that originally launched their businesses aren't even in demand today. In 1939, Bill Hewlett and David Packard partnered up to launch Hewlett Packard. The product that launched the company was the Model 200A audio oscillator. They literally baked the paint of these first units in a kitchen oven. David Packard's wife said food never tasted the same. They priced the unit at $54 when competing products were $200 to $600, and sales just took off. You know, I don't think anyone is buying the Model 200A product today, at least I sure hope not. You know, the company evolved, they innovated, they adapted around their customers' needs to become one of the world's largest electronic instrument manufacturers. Other companies haven't evolved fast enough. In 2005, the newspaper industry was a $55 billion industry. Today it's $10 billion. An entire industry almost gone in just 14 years. The internet has transformed and destroyed many industries. In the last 5 years, online retail sales as a percentage of total retail sales has gone from 7% to 13%. And you know, it doesn't sound like a big jump, but it's very material losses for brick and mortar retailers who didn't adapt and pivot to digital channels quick enough. You know, what is the result? In 2017, 21 U.S. retailers declared bankruptcy, including Toys R Us, The Limited, and Payless. In 2018, 16 more U.S. retailers declared bankruptcy, including Bon-Ton, Nine West, and Sears. In 2019, Diesel, Forever 21, and Gymboree declared bankruptcy. These retailers failed to adapt, evolve, or die. You know, I can't help but add this Charles Darwin quote, which many of us know, is not the strongest of the species that survives, nor the most intelligent that survives. It is the one that is most adaptable to change. When people think old, they think slow, set in their ways. You know, they basically think of an old person. You know, and this is the wrong lens to view older companies. The Henokiens Association is an association of family-owned companies that have operated for more than 200 years. There's 48 companies in this association from around the world. One association member is a company named Catherineau. The company was founded in 1750. The company's founder, Pierre Catherineau, began the company making cartwheels. The business would evolve and grow from generation to generation. And today, Catherineau designs and manufactures made-to-measure interiors for aircraft and yachts. The company's customers are the rich and famous and powerful, mainly in France. The company has now been passed down to the 9th generation of family members. The family credits their business success and endurance to the following values. Number one, constantly reinventing their business to survive. Number two, constantly adapting to their environment. Number three, meeting and exceeding customer expectations. You know, this doesn't sound like an old, slow-thinking company now, does it? You know, in fact, what you'll find is old companies are often the most innovative and adaptive companies. They wouldn't have survived 50, 100, 500 years if they weren't innovative or adaptive. So if we want to survive as investors, we can take a valuable lesson from these old companies. We really need to evolve or go extinct. You know, if you're still investing the same way you did 20 years ago, you aren't growing. You know, you need to challenge your convictions. You need to surround yourself with people that share your values but think differently than you. You know, I run into a lot of investors that are still talking about the wins they had 15 years ago. You know, don't spend the next 10 years bragging about the returns you had 20 years ago. Keep learning and evolving. You know, Warren Buffett built his early wealth in a completely different way than he invests today. Early on, Warren Buffett made 50% CAGRs by flipping through Value Line and finding 3 PE stocks. You know, that doesn't work anymore, and he changed. He surrounded himself with smart people like Charlie Munger and others that had similar values but thought differently, and Buffett's strategy evolved. We can all learn from this, you know, evolve or go extinct. Here is a chart of the major events over the last 40 years that impacted the markets. And if we're being honest, it's easy to get through the points above the line when times are good. It's easy to survive a bull market. But how do you make it through the drawdowns? It's in these drawdowns where each decision you make, both good and bad, is amplified. If you let your emotions get the better of you during a bear market, it could destroy your next 5 or even 10 years worth of returns. I love this quote. You make most of your money in a bear market. You just don't realize it at the time. A few weeks ago when COVID-19 was just starting to impact the market, someone asked me, what are some of the lessons you've learned managing capital through a bear market? I thought about it and I came up with 7 of them. I'd like to share some of these, or I'd like to share these 7 with you today. Lesson number 1, cash is king. And there's 2 parts of cash is king. Like number 1 is savings. It's important to have enough cash to cover your personal expenses, at least I believe, for 12 to 18 months in case you lose your job or just times get tough. When you've prepared for your worst case scenario, it gives you the emotional stability to invest the rest. Nothing's worse than having to sell stocks in a falling market to pay bills. I've been there and it's not fun. The second part of cash is king is just having dry powder. If we're all being honest with ourselves, bear markets and market drawdowns are only painful when you don't have cash to take advantage of them. When you have cash, you have confidence. When you don't have cash, you're just like everybody else. Knowing you have some cash to deploy keeps you financially and emotionally stable. Always have cash on the sidelines. Lesson number 2, cut your ego and cut your expenses. Times like these are, sort of a reminder of why it's important, especially for full-time investors, to keep your fixed costs low and your variable costs variable. Your ability to throw away the ego and pull down your expenses, pull down your cost structure, is what keeps you in the game. Also, if you have a job, just reining in your expenses frees up capital to deploy. Lesson number 3, control your emotions. When the market goes higher, it makes you want to chase prices. It makes you want to buy. When the market moves lower, it makes you want to sell. The market never screams at you to do the right thing. It only screams at you to do the wrong thing. And it's important to slow yourself down. It's human nature, when you see your portfolio lose value quickly, it makes you want to buy. It makes you want to make it back twice as quick. This is when you make bad decisions. And it's important, if you make one bad decision, not to compound it into many bad decisions. I find, at least for me, I become more emotional the shorter term I get. And so when I feel myself getting impatient, I purposefully slow myself down by recalibrating to 3-year time horizons. And, what I do is I look at every single one of my positions and say, can I conservatively double my money in this investment in 3 years? And it's really interesting how just saying that out loud, just kind of makes me slow myself down. Lesson number 4. Create a wish list or buy list of companies, because guess what? In a bear market, you might just get your wish. Investors love to look for new opportunities when times are good, but the best times are when most investors are too afraid to look. When you do have cash, it's easy to just kind of sometimes sit there mesmerized by the daily market action, by the ticker tape, instead of spending time creating a buy list of companies. It's important, you need to know what you want to own so you have the confidence to pull the trigger. Lesson number 5. Sell the weak. In a COVID-19 world, almost all businesses will be impacted in some way. And it's really a question of how much will they be impacted and for how long. Will they show a 10 to 30, 70% decrease in revenue? How long can they sustain a reduced revenue run rate? 1, 2, 3, 4 quarters? Once the world is back into business, what if it takes a year to get back to normal, not just a quarter or 2? Do your companies have the balance sheet to get through it? These are the questions you have to ask yourself. I like to stress test my investments. I literally create an Excel spreadsheet, and a very simple one. I take revenues down by 50%, even 100%, depending on the business, and keep OpEx the same. And I just see how long they can survive, how many quarters. And I'm very aware of that. If your companies can't survive, your portfolio won't survive. Balance sheets don't matter until they're the only thing that matters. You need to sell the weak. Now, I would like to mention that some people do the opposite of this. They actually look to find companies in a bear market the rest of the world thinks are going broke. But maybe their analysis of liquidity and debt covenants or partners tell them that it can survive, and you can make a lot of money by doing this. But unless you really know what you're doing, it's more like gambling than investing. So be very cautious. Until you're at a very experienced level, Sell the weak as quick as you can before someone else does. Lesson number 6, stop trying to pick a bottom. I find it's too easy during a bear market to start getting cute and making yourself feel productive by studying the macro environment and turning yourself into a market strategist instead of a business analyst. You got to knock it off. Stop trying to pick bottoms when you should just be analyzing the heck out of that wish list of companies you have, formulating where you think those businesses will be in 3 to 5 years, hopefully well out from COVID-19 being in effect by then, and buying a little, knowing that you might look dumb in 3 to 6 months, but that's okay because you'll just buy more. The only investors that know how to pick bottoms are liars. Slowly buy the businesses you like lower and lower. Don't worry about looking wrong in the short term because you'll be right in the long term. Lesson number 7, get more diversified. I find that a big mistake of a lot of investors make during a bear market, especially concentrated investors, is actually getting more concentrated. If you're in 8 positions, you concentrate down into 3 or 4, thinking you understand the risks of these businesses. These are unprecedented times with risks that are kind of hard to comprehend, especially the tail end of the risk, how long it will go. So you should really be doing the opposite. Now is the time to really draw down and drill down on that buy list of companies and know what you want to own and wait for the valuations you want and get more diversified as the market drops and reduce your individual company risk. For example, for me, 9 months ago, I was in maybe 8 companies, and today, in the middle of COVID-19, I'm in 13, and I hope I'll be adding another 1 or 2 as prices come down on other companies in my buy list. And so I think these 7 things, these 7 lessons, can really help you not only survive a bear market, but set you up to outperform over the years that follow one. And when you think about these things, these lessons, it's really the opposite of what many investors do. Most investors don't have cash set aside for a worst case scenario. They're forced to sell positions at the worst time. They don't have dry powder to buy stocks in a bear market. They either can't or refuse to cut their expenses to help weather the storm and to invest more. This causes their emotions to rise because they can't buy when stocks are on sale. Investors normally sell their best companies to average down and to concentrate into their weakest positions, trying to make their money back quicker. And guess what? Then you go broke. I find that successful investing is hard work because it means disciplining your mind to do the opposite of human nature. Bear markets have had the biggest impact on my investing. In fact, they've helped define what I look for in a company. And here's just 4 quick things, and I could probably spend a whole presentation on these 4, but I'll go through them quickly. Number 1, a business that can grow through a recession. To be honest, just that one there, it probably takes the universe of stocks down to, I don't know, maybe 7%. That's probably what's left. Number 2, a balance sheet that can weather a storm and act with occasional boldness. Probably takes that 7% down to 5%. A leadership team and organization that shows signs of intelligent fanaticism, probably takes it down to 1%. And number 4, a valuation that can conservatively double in 3 years, probably takes it down to 0.5% of the total stock market ecosystem. And that's okay because I can't control the market. I can't control stock prices. I can only control where I'm invested. When you're invested in businesses, at least for me, that have these 4 attributes, I know they can weather any storm. I've evolved quite a bit as an investor over the last 20 years of my investing career. When I first started out in the early 2000s, I was investing in that company that I told you about in my opening remarks, that disaster remediation company. I was basically a story stock investor. Really, I was a momentum trader. I didn't even bother really to look at financial statements. Soon after that, I pivoted into precious metals and mining and life science companies. I learned those areas by studying these industries and also studying some investors that were really good in those areas. And then I pivoted into more of the GARP and compounder type of businesses. And today, my strategy encompasses actually all of these areas. I called this presentation Art of Survival because investing is an art. You are the artist and your painting will be different than mine. This chart on the screen, my journey, is my painting. And the way I invest is unique to me. The great thing about investing is you can reach your goals in a variety of different ways. Some of the greatest investors ever had almost opposing strategies. So don't be afraid to be unique. Don't be afraid to be different. as you go through your journey, you know, kind of like how I have mine, you'll end up having some crazy stories like I have, some of them painful, but you'll end up developing a strategy that is unique to you. And your edge is in those areas where you think differently than the majority of other investors. And you need to embrace that. Thank you.